Now, there's no doubt we expect growth to be slower than last year and the rapid clip we had. But that's consistent with the transition to a stable, steady growth and lower inflation. There's going to be a lot of chatter today on Wall Street and among pundits about whether we are in a recession. But if you look at our job market, consumer spending, business investment, we see signs of economic progress in the second quarter as well.
That was President Biden sounding very confident about the state of the economy following today's negative GDP print. But our next guest is much more bearish. No surprise if you know David Rosenberg. He is the founder and president of Rosenberg Research. He's worried that home sales are dropping fast. Mortgage apps are at their lowest levels in 20 years. Real capital spending is on track for a negative year. And the labor market is nowhere near as healthy as it seems. David, good to speak with you.
Is it?
I think so. I mean, if you think about what you said, isn't that exactly what the Fed wants? And so if what you say is the truth and that we are headed for a much sharper slowdown more quickly than others think, then that means the pivot is closer than we think.
Well, I'm not so sure about the pivot, depending on how you want to define it. I think there was a definitive change in tone and strategy going from a pre-commitment to raise rates aggressively to data dependency. That makes perfect sense. But it's going to take a lot for the Fed. When you're talking about a pivot, as in, cutting interest rates, the Fed is going to have to see the whites of the eyes of the disinflation. In the meantime, they made it very clear that they're willing to accept a very weak economy to achieve their goals. The only chairman that's ever raised rates into a recession was Paul Volcker. Back in March of this year, in front of the Senate, in an exchange with Senator Shelby, Powell compared himself not to Arthur Burns and not to William Miller and not to Alan Greenspan, but to Paul Volcker. We know that Paul Volcker killed inflation by killing demand for the greater good down the road. And I think that is the road that we're on right now.
But if you hear about an economy that is slowing in growth, but nearly everybody is employed, David, that there are plenty of jobs out there. And then you piece together what we're hearing from these tech giants like Amazon, which saw actually strength throughout the quarter in demand, and Apple, which is not seeing much of an impact at all on iPhone demand. Do you then piece together a picture that, maybe it is possible that there is a soft landing to be had?
Well, I've never seen a soft landing, with sequential negative prints, unreal GDP. And frankly, there's actually negative momentum. It's early days yet into the third quarter. A soft landing is not a contractionary economy. A soft landing is when the economy is growing below potential. That's not happening. The economy is contracting. Now, I understand that Jay Powell is not going to raise rates 75 basis points and then at the podium talk about how horrible the economy is. He can't possibly do that and keep a straight face. But to talk about the labor market, it's the last thing to go down in a recession. It is a coincident indicator. The Fed is actually following contemporaneous or lagging indicators, and people should know that. They're focused on the unemployment rate. Unemployment is actually one of the Conference Board's components of the index of lagging indicators. Is that really what you want to look at as an investor? Non-farm payrolls, the holy grail, is in the index of coincident indicators. And non-farm payrolls never once have ever given you the recession signal as it's been happening. The only two components of the labor market that make it into the Conference Board's leading economic indicators is the manufacturing work week, which has rolled over significantly in the past 3 months, and initial jobless claims. That's a leading indicator, and they're up more than 50% from the lows, and that is a recession signal. So I'd say that it's immaterial to talk to people today who want to drive by looking through the front window about what employment's doing today. It really lags the cycle. I'd like to ask Jay Powell, where do you think employment's going to be 3, 6, 12 months from now? Not where it is today. And my sense is that the labor market is going to be looking a lot different in the course of the next 12 months than it has in the past 12 months.
David, in terms of the market, I think it's taking its cues over the last couple of days because the data's been so weak and because there's this belief that somehow the Fed can take their foot off the gas in terms of hiking, and maybe they'll even be accommodative again. So I'll play that out and say, okay, you want to play that game? If in fact that's the case, the thing they're trying to fight, inflation, is just going to get worse again because commodity prices are going to explode to the upside. Thoughts on that?
Well, I guess that you can say that words matter, but actions matter more. And the reality is that Powell still retains a de facto, what we used to call in the old days, a tightening bias. They didn't have an easing bias in the press statement. They had a tightening bias. All he said was, now that we've gone to neutral, we don't have to pre-commit to 50 or 75 basis points anymore. That's just logic. I don't know. I know the stock market's interpreted a certain way, but we all know that the markets will just do what the markets do, whether it makes sense or not. I'm not going to say, I think it'd be ridiculous to say that Powell was dovish. He basically said, we have a tightening bias on the books. He's going to be data dependent. If we print negative payrolls or if inflation comes crashing down, which might happen given what's happened with food and energy in the past little while, maybe they'll go a small amount in September. Maybe they won't go at all. We'll probably have a better feel for it with the Jackson Hole Symposium in August. But the sense that he pivoted, or the sense that he's turning dovish, way too early for that. Here's what we know with certainty. We know with certainty that what the Fed does in time A has an impact on the economy 4 to 6 quarters down the road. I mean, these guys just started hiking rates in March aggressively in the face of a recession that they didn't anticipate. Remember, when we went into this year, the Fed gets accused of blowing it on transitory. Nobody says, didn't you bungle it on the economy? Because in December, they were calling for 4% real growth this year. In June, they cut it to 1.7. Now we're going to be 0 to slightly negative. And so they bungled the real side of the economy too, or maybe that's exactly what they want to kill inflation, and the economy is going to pay the price for it. But you see, I don't know the extent to which or the magnitude of the recession. I just know it's going to last a lot longer than people think, because we've already had 2 quarters of negative growth. A lot of that, by the way, is from the fiscal policy contraction. Fiscal policy is contracting at a record amount this year. Nobody talks about the fiscal drag on the economy. And what the Fed's already done, 225 basis points, hasn't even shown up yet in terms of peak impact. That's going to be next year. So they can actually go on hold. I don't care. They can go on hold in September, and the markets might go through another extended bear market rally. But the risk is having tightened into the recession, and this is a recession, having tightened into the recession and not seeing all the lags kick in yet, it's going to continue probably not just these past 2 quarters, but the next 4 quarters. And that'll be, I think that'll be the real comeuppance for risk assets when they realize, oops, it might not be a deep recession, but it's going to be lasting longer than we had anticipated.
David, thank you. Always great to get your thoughts.
Thank you.
David Rosenberg. Dan Nathan.
Listen, I've followed Rosie's work for 20 years. He's about as thoughtful as it gets. And one of the things I think is his superpower is his ability not to be in consensus. And that means that he's going to be early sometime. But I really think that he's had this call correct. I know that, some of us, and I think he was in that camp, that thought that inflation was going to be transitory. That's going to be semantics, because look at how we've seen all of these kind of inflationary pressures, they have come off. If you look at it over a 3-year period, they've been transitory. His point, I think, is a really important one that he made about the Fed, where they screwed up with their expectations for growth and then also keeping their foot on the pedal of easy monetary policy last year. So when I think about what he just said to me, I think investors better be prepared for longer duration of recession. And I will tell you this, the S&P 500 down 15% on the year, no matter what you think you just heard from corporate earnings over the last 2 weeks, is not going to encapsulate the recession that we're likely to have. And the last point we didn't even get to make, but you saw it up there on the screen, what he thinks about housing. He's pretty good at calling housing bubbles here. If that were to happen, the negative wealth effect of that and the stock market and all these other recessionary factors, I think is not a great setup. So to me, I do expect the S&P 500, it can maybe go a little bit higher here, but I expect a retest of those lows that we saw in June.